we've got a voice in from Moody's, Nidhi, Dhruv, the Vice President at Moody's Ratings, joining in on the show right now. Nidhi, hi, morning. Good to have you on ET Now. You've downgraded IndiGo's human capital score now to 4 from the earlier 3 and flagged governance issues as well. But the overall BA3 rating and stable outlook remains unchanged. Tell me, what specific quantitative deterioration financial metrics are you looking at right now, which would trigger a formal downgrade of the long-term issuer rating?
Well, thank you. So as we pointed out, the recent disruptions will negatively impact the current fiscal year numbers, and that's mainly because of the loss of revenue, not just from flight cancellations, but also refunds and other compensations that will have to be paid to affected customers. And also there could be potential penalties that may ultimately be imposed by the DGCA. We've also noted that the DGCA has issued show cause notices to IndiGo CEO and COO, which may ultimately affect in continuity of senior leadership at IndiGo. And in light of this, as you rightly pointed out, we have downgraded IndiGo's human capital score, and that really reflects the adverse impact of slower hiring on the airline's operation to prepare for this upcoming change in regulation. And we also noted that while IndiGo does not have any employee unions, what this recent disruption shows is that its pilots, through the broader pilot associations in India, still possess significant collective bargaining power. And we've also pointed out the moderate exposure on governance, again, going back to just the management's lack of judgment and preparedness for the impending regulatory change. But as you rightly pointed out, ultimately, the fundamentals of IndiGo's Baa3 rating remain intact. These include their dominant market share, low penetration rates for air travel in India, the strong macro growth fundamentals. I mean, India is still the fastest growing G20 economy, and IndiGo has the largest market share of 63-64%. And we believe IndiGo's long-term ratings will be supported by leverage remaining below 3.5 times. What we have in terms of the down triggers is exactly that, leverage of below 3.5 times on a sustainable basis. And we also have a margin trigger on IndiGo. So if the EBIT margin falls below 13%, again, on a sustainable basis, or if its liquidity deteriorates significantly, then that would be a cause for concern.
Right. Nidhi, hi, good morning. This is Harsh here. What is your sense with regard to the credit rating itself? Do you believe that there is absolutely any risk for the moment with regard to the credit rating, and what could the triggers of a possible change in credit rating actually be, in your opinion?
I'd say it's a little early to quantify the impact of this. So we are obviously watching the space, but given we have not taken any rating action thus far, and as I mentioned, the fundamentals of the Baa3 rating remain, the rating is still on a stable outlook, but the situation will evolve, and ultimately it will be governed by the longer term strategy that the company takes, and also the longer term size, scale, and profitability of IndiGo's operations under the new regulatory requirements.
Okay. And do you see substantial risk of an overhang continuing all the way through February? Because they've obviously got a little bit of leeway till February, but do you believe that the problem can be fixed by February? And if not, what impact could that have in your opinion?
I'd say early to say. I mean, from the company's standpoint, there would have to be a short-term strategy that takes them through the 10th of February until when the DGCA exemption remains valid. And then there will have to be a longer-term strategy. It would be unrealistic to assume that, to even expect that they could fix the crew issues and they could hire more crew and have everything in shipshape by the 10th of February. So there would have to be some interim measure that the company is taking, and I mean, we'll have to wait to see what they come out with. But the longer term strategy, is one that this this time that the DGCA exemption provides them till 10th of February does give the company some time to remediate the situation and think out their longer term strategy, which would need to be a little bit more nuanced.
The other thing, Nidhi, that I also wanted to talk about was, the fact that in your report, and I was just going through it, it mentions that you expect the FY26 profitability to be negatively impacted. Have you modeled the potential impact of needing approximately 20% more pilots per aircraft to comply with the FDTL norm? And what does this suggest for the airline's cost structure and competitive pricing ability?
I'm afraid I think talking numbers again a little bit premature at this stage. We don't know if it's going to be 20% more pilots, or it's going to be a scaled down operation, or it's going to be resetting of some of the price points. I think this goes back to the company's strategy, and we would have to take into account where the buffers are. Ultimately, from a rating agency perspective, we are also taking a longer term view. We are meant to be rating through the cycles. So a dip in profitability in the current fiscal year is not going to determine the long-term rating fundamentals of IndiGo, and we would be rating to the company's longer-term strategy.
Interesting. Nidhi, thank you so much for your time today. Great to be speaking with you and getting all that insight on IndiGlobe.
Likewise, thank you for having me.
Right, okay, that's Moody's and their rationale behind, their issuance now on IndiGlobe Aviation. We'll take a very quick break on that note, but continue talking stocks on the other side.